This video now is the second video in the series which I am doing about basically giving investment tips. I came across an old notebook of mine, green notebook, I have a lot of tips in it written down to remind myself about investing in shares especially, but some of the tips also apply to investing in property. So to continue the theme from the first video I made in this series, where rule number 1 is don't lose your money, rule number 6 in my series, and the first video has 5 tips. This video will have 5 tips as well, and this is video number 2. But the first video I said don't lose your money, and to labour the point a little bit, tip number 6 is about smart entrepreneurs and smart investors doing everything they can to reduce risk, and reducing risk with a voice or with a view to not losing their money. So tip number 6, smart entrepreneurs do everything to avoid losing money. Tip number 7, buy shares in companies who make products or provide services that you actually understand. That's a useful way to view a company, view a share, understand what the company does, understand what they sell, whether it's a product or service. I would recommend, and smart investors recommend, buying shares in companies in which you understand what they do. And that's because when you're buying a share, you're not buying a betting slip or a lottery ticket. You're buying a slice, very small slice of a company, but nevertheless it's a company that makes stuff or provides services, has employees, and so on and so forth. So for the ordinary average investor who is prepared to be a value investor and buy for the mid to long term, buy in companies you understand what they're doing. Buy. Tip number 7, buy and hold. If you buy and hold a productive asset like a share, which is essentially a very small sliver of a company that's making money, making profits, selling products, selling services, that's a productive asset, as opposed to cryptocurrency or a non-productive asset, which tends to be more speculative. But if you buy and hold in productive assets, then you're going to do well in the medium to long term. That's tip number 7. Tip number 8 has to do with the average profitability of companies on stock exchanges. The average apparently return for a company per annum is 8% per annum. That essentially means that the company or the stock exchange will double in value every 8 or 9 years. It's a simple mathematical equation. It's a simple function of compounding and the power of compounding. So if you have a share in a company that's increasing profits by 8%, 9% per annum every year, well then the value of your investment should double every 8 or 9 years. I'm forgetting the bloody numbers now. Tip number 9, your timing doesn't have to be perfect. You don't have to buy at the top of a cycle and you don't have to sell at the bottom of a cycle. Your timing does not have to be perfect, and nobody can predict the future. Nobody can predict an exact turn in the market. But if you buy shares in companies who engage in activities that you understand sell products and services that you understand, and you buy and hold those shares for medium to long term, you should do well and get a good return, very good return. That's tip number 9. Tip number 10 is you don't have to, if you buy a basket of shares, pick winners, all winners. And the reason for that is very simple. If you invest 10,000 euros in a share and it turns out to be a complete loser and you've lost your 10 grand, well then the limit, the maximum you can lose is 10 grand. However, if the share goes the other way, there's no limit. The sky is the limit. You could buy a share in a company whose value doubles or trebles or quadruples fairly quickly or over a relatively short period of time. But the bottom line is there's nothing to prevent a company from having a share worth, say, €1 now, and it's worth 10 euros in 10 years time or whatever. So there's no cap, there's no limit on the upside or potential increase in value of the share, whereas there is a limit when the share falls. There is a limit. All you can do is lose your money, lose your investment in that particular share. So that's why if you buy 3 shares, 5 shares, 10 shares, and you have 1 or 2 losers, you can more than compensate for the losers by the winners, because the winners have no limit or no constraint on the upside, whereas the losers do. So that's tips 6 to 10. This is my second video down the Canal Bank here in Enfield. It's the 23rd of April, 2025. I think. Let me get this set up here. This is the second video in a series of videos that I'm doing. I probably will do one more, maybe 2 more, definitely 1 more. I've already done one, and that's called video number 1 or whatever, investment tips. I have a course as well about investing in shares. It's an informational or educational course about share investing, and it explains investing in shares, essentially the terms around investing in shares, and I share with you the shares that I've invested in and the strategy that I use. And I'll tell you now what the strategy I use is: I buy shares and I hold them for the medium to long term, and I buy shares in companies who engage in activities that I understand. That's really it, and I've done really well with the share investing, but I'm not making any promises about how well you'll do or otherwise. But if you're interested in shares, if you're interested in investing in shares, if you're interested in learning about shares, my course might be useful to you. Have a look at it if you like. It's available online. It's an online course. There's a number of videos and stuff in it, and it's available on Gumroad, or it's available underneath this video if it's on YouTube. I'll put a link underneath this video on YouTube, and it's also available on my website, businessandlegal.ie. It's on that website as well. So hope you liked the video. If you do, hit the thumbs up button down below. Thank you very much.